You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got Chase Taylor. Chase is the founder of Pinecone Macro. He's based in DC. So Chase, thank you so much for being on the podcast. It's awesome to have you. You were sort of one of the best, people, especially on FinTwit when it comes to macro. And it is amazing to get you back on the podcast and to share some of your thoughts as well. So
yeah, it's awesome to be back, and I'm just glad somebody recognizes I still do macro and not just energy. So that's good.
Yep. So Chase, before we get started, during our last review, you sort of talked about your background. Could you just give us a quick synopsis of your background and what you do at Pinecone Macro, before we get started?
Yeah, sure. So my background is mostly in the military. I've been involved in markets since 2008. Not good at it until about 5 years ago, but but before that, I worked on B-1 bombers in the Air Force. I did some geospatial intelligence work and some acquisition work. Worked at some government labs and some intelligence agencies along the way.
Yep. And do you think sort of your background in defense has influenced the way you invest, or are there any lessons that you learned while you were in the military that you've sort of applied to investing?
Yeah, there's definitely some frameworks. One of the examples I like to use is in intelligence. Like you have to kind of get to know your own biases and really fight against them, because lives are on the line if you have a bias that kind of like gets, if you have a bias that creeps too much into your analysis, you can cost people's lives. And we all have biases. Like we all feel them. We all, suffer from the impacts of them, but in that line of work, you have to understand them and, like a red team against your own biases on a daily basis to do your job well and to keep people alive. So that was a big help, and as well as just like some basic frameworks that are used for, understanding the difference between fact and fiction, essentially.
Absolutely. And controlling your biases sort of essential in markets. And going forward, just wanted to start off by talking about the one thing that you've sort of really become well known for on Twitter, and that's energy. And so it's been sort of a home run trade, clearly. So could you sort of talk about number one, how you found the energy opportunity, and what actually went into the analysis before you took the trade, and going forward, what's sort of the risk reward from here, and how you're thinking about it right now?
Sure. Yeah, the risk rewards definitely changed a lot.
Yep.
But so just kind of how it got there. So I like to find things that are very much unloved. That's like a really good starting point for me. Things that are unloved and things that are like just performing badly.
Mm-hmm.
So obviously that was the entire energy space a couple years ago. So it kind of attracted my attention. I like to find things that are in that position, but you can do some fundamental homework on and realize everyone's extrapolating that to keep happening that way, but it's not going to keep happening that way after you have done your own deep dive into like what's the real drivers. So the basic way of looking at that is a capital cycle framework. This is just kind of a cycle where capital chases after high returns, and then it ruins those returns. So if you think about oil, pre 2014, oil was expensive. So you had a ton of investment. You had a lot of people chasing after it. Sentiment was high. You had the shale boom. Everyone was, lining up to give shale money to just, burn up and put in the ground and overspend. So you had that situation, which obviously leads to the situation where you have a price collapse and then you have an investment collapse. So really since 2014, the oil market has been, just really energy market has been just completely broken when it comes to investment. There hasn't been enough investment. There hasn't been enough, looking for new oil, and eventually that leads to much higher prices. You have to get the capital to come back to, expand production in the future. So we're kind of at that point where finally the market, realizes the fact that we don't have enough energy, and now we have to have a lot more investment in the future. And so far, we're not getting much investment response, especially in public markets, and especially in, say, non-state-owned players. And that will, as long as that's the case, we'll continue to have high prices. But eventually you get a capital response, you get a bunch of capex, you get a bunch of increases in capacity and production, and that's what flips the entire market back on the other way. And that happens whenever you get really high prices. So when we get back above $100 a barrel, later this year, next year, people will come back. As much as they want to, keep giving dividends out and everything, at some point, oil equities go a lot higher, and then these CEOs are all of a sudden, their incentive is to go get more oil instead of just hand cash out to their investors. But you could argue for a time period, there's going to be a lot of cash handouts, a lot of buybacks, a lot of debt being paid down, because there's at the moment, if I'm an oil CEO, especially a public one, there's really not much incentive for me to go expand production, because no one's reflecting any of this reality in the share prices of oil yet. Really, you see it on the front end of the futures curve, not in the back end, and not in oil equities yet. So there's definitely still runway, and it's not like you flip a switch on oil production and it all comes rushing back in 2 months. So you have the runway of the timing to bring all that back onto production, but you also have the timing to wait to actually get this capex boom, which eventually comes.
Yep. And how did you go about sort of expressing this trade? So I remember you talked a little bit about coal equities as well. Coal is sort of a similar trade in terms of the capex cycle. Did you also play that through futures, or how did you go about constructing that position?
Yeah, so as a macro strategist and a person that's bad at single stock investment, I just gravitate more towards futures than equity, just in general. So it was very futures focused for me, but I definitely played it through equity, because it's just it was so undervalued. And for me, that was a mixture of kind of breaking it up between really low risk equities and then some really high risk ones. So I went to low risk ones in case oil went back down or stayed sub 50 somehow, that whatever I owned probably wasn't going to go bankrupt. So there were actually oil companies during the pandemic crisis where oil went negative that had zero debt, and so naturally I'm going to go buy something like that that's reasonably well run, had zero debt, so it's like a big cushion there. But also wanted to go get some stuff that is probably going to go bankrupt, or if it narrowly escapes bankruptcy, it'll get re-rated at a really aggressive clip. So yeah, you mentioned coal. That was the reason I focused on Peabody. It was priced to literally go out of business, and I didn't think it would. And I knew if I was right, the re-rating, it would outperform all of its peers that weren't priced for imminent bankruptcy. So there's a place for that, but it's obviously it's much higher risk than just buying some futures or buying an equity that doesn't have a bunch of debt. So for me, it's definitely a mixture of futures and equities, and then even within the equities, kind of some safe stuff and some more aggressive stuff.
Yep. And does it scare you that the trades? So if you go on FinTwit, everyone's talking about oil and energy and coal, and especially in Europe, where there's sort of a massive shortage and prices are to the roof. So do you fear that's become crowded? It's sort of become a crowded trade, and public sentiment is starting to peak slowly, or do you think there's still a lot of runway left?
Yeah. So the funny thing about this is, so the sentiment, it does it's like it's definitely a yellow light to me. I don't like seeing economist covers with natural gas on it. When I started investing in natural gas, no one cared. Everyone just extrapolated it to be $2 for the rest of history. But positioning, interestingly, speculators are net short natural gas. They're not very long oil. So these rates are still unloved, and it's not like institutions are like, you know what, maybe we should buy coal equities now. You're not going to see that. So from a pure positioning standpoint, I have no worries. In fact, I'm very encouraged that the bull market kind of continues. But from a sentiment perspective, it's definitely a yellow light right now because it is getting a bit of attention. There's a lot of articles. The energy crisis angle has brought a lot of attention to, kind of markets that people normally don't pay attention to, because when the lights go out, people really kind of pay attention to things naturally. So yeah, sentiment a little concerning, but and if I didn't think we were going to have a cold winter, I would be much more concerned about gas and coal because they kind of need that at this point to keep moving higher. Whereas oil, I just think the runway for oil is significant. And when it comes to the natural gas market, though, something that maybe doesn't get enough attention here in the U.S. is just the role that exports are playing. But for so long, we didn't really export, natural gas, and now we do, and that's really changing the game. So yes, we produce more, than we did a few years ago, but we export so much that it kind of remains a tight domestic market, and the arbitrage for prices between US and then Europe or UK or Asia, it's a giant gap in price. So there's so much arbitrage opportunity there. You can kind of see what happens. Like all these prices have to kind of meet in the middle at some point to make nat gas go from a regional market to a more global market. So that's sort of like a natural just tailwind for US natural gas prices, and kind of medium term, call it.
Yep, and as you mentioned, this starts sort of institutions in the sense of endowments. A lot of these foundations, they've started to, I guess, divest from energy investment. And I guess that's sort of encouraging to your thesis because you sort of don't have all these in terms of sentiment. I guess that's sort of the anti-sentiment. Considering that a lot of them have started jumping on the ESG train. And speaking of ESG, the other sort of commodity that you've been big on is uranium. And could you just number one talk about the macro for uranium as well as how you're actually thinking of playing it? Is it again through futures, considering that futures on uranium are actually far more illiquid compared to something like oil? So
yeah, I wish I could trade uranium futures. I would very much like that, but they don't move. Like I was told that, and I could see that on the screen, but a few years ago I still tried it, and I put in an order, and it just nothing happens. So yeah, I hope I get to see a day where there's a liquid uranium futures market that I can trade, but because the leverage makes futures just really nice to trade. But yeah, for me that's all about equities, and I know a lot of people really are kind of left the uranium mining space and are focusing on the physical trust. For me, I prefer to be in the actual miners personally. But as far as the actual story goes, I think what's happening with this energy crisis, and again, I think it'll get worse this winter, is it's changing the kind of public relations, the narrative around uranium. So while everyone's focused on the Pac-Man of the Sprott Trust, I'm focused on the fact that we're going to see a lot of significant players, both politically, and otherwise, go from not being a fan of of uranium to being a fan of nuclear. Because you get to the point, for one thing, everyone's like, oh, it's too expensive. It's too expensive. It's too dangerous. Yep. We don't know how to store the waste. Well, it's not expensive whenever natural gas is at a $200 a barrel of oil equivalent. It's actually dramatic. It's super cheap. The fact that it doesn't turn itself off, whenever it gets cloudy or the wind stops or the water stops flowing, that becomes like a really big deal. And it's all these things we take for granted about certain forms of energy. Whenever you have a crisis, become clear. So things we haven't had to worry about for a long time, all of a sudden are giant risks. So I think, green parties throughout Europe, or maybe, you look at like Taiwan or different places that have kind of been, anti-nuclear in some ways, or trying to like draw down their nuclear. Even France is kind of the champion of nuclear, and they were going to draw down, the number of plants they had. But now they're saying, well, maybe not only are we not going to do that, but maybe we're going to add some nuclear. We're going to start investing more. And I just think that's the very beginning of a giant new wave. And it's going to be a true nuclear renaissance, because it's going to be proven to be, the most superior baseload energy you can get. You get a lot of energy, and all you need, is a reaction based on this very abundant mineral that we have. It's almost like a miracle that we just all take for granted. As Josh Wolf has recently said on Twitter, if we discovered, nuclear power today, we would just think it was a miracle, and it was the answer to the climate crisis. Like, oh well, all we got to do is use some cheap uranium here to make a reaction and get a bunch of electricity. So I just think the future is really bright, and I think mostly it's because there's going to be a significant ramp up in the amount of nuclear reactors around the world in the next, call it 15 years.
Yep. And when we were chatting on Twitter, you were sort of, I guess, highly convinced that like very soon, say within the next 6 months to a year, we're going to see a shift in public sentiment. So what do you think is going to change here that's going to actually cause public sentiment to become pro-uranium? Because people usually bring up the old uranium is dangerous, or they bring up 3 Mile Island and Fukushima, and then they make the same arguments over and over again. So what do you think is actually going to cause public sentiment to change permanently this time?
For one thing, the lights going out and the heat turning off, that gets people's attention. So in my opinion, a lot of policymakers maybe read a couple of paragraphs in a magazine about nuclear and made up their mind. They didn't do their homework, because if you do your homework, in my opinion, it's really clear that it is very safe and obviously very effective. I think the price angle, that was not crazy to say. Like 5 years ago, you're like, man, I don't really want to build a nuclear plant that costs tens of billions of dollars. Like that's fair whenever natural gas is $2. So I understood that angle. That kind of made sense. That's changed. So price has a way of influencing people's ideas about things. And for whatever reason, the storage of waste is a big deal. I can't wrap my head around that, because when I've studied it, it seems like it's not that big of a problem. But the biggest thing, is I think this will at least force a lot of people that haven't actually done their homework to actually do their homework. And when they do, they're going to realize, like, okay, this is way cheaper than what we're dealing with right now. It's way more reliable than what we're dealing with right now. We don't have to import it from Putin, or from our neighbors, or get it on an LNG ship that takes time, go across the water during crazy shipping era.
Yep.
So I think something that's cheap and reliable and safe, it will eventually find its way to being used on a significant scale. And I just think that's all lining itself up to inflect, especially if the winter energy crisis gets worse than it is now, and it's already really bad in Asia and Europe. So but you're already seeing it change the sentiment and change policy around the world for nuclear. And I just think that is it's more and more as we go through the winter.
Absolutely. I know you're not Chase the energy guy, you're Chase the macro guy. So I wanted to move on from energy. Talk a little bit about the other thing that's sort of on people's minds, which is inflation. And number one, do you have any thoughts on the transitory nature of inflation? And do you have any views on other commodities, say gold, silver, or even currencies like the US dollar, based on that kind of thinking?
Yeah, so as far as inflation goes, I've been writing about it being less transitory than it is expected for months now, and I think that's starting to play out. And I think we've seen metals tried to break out today. This Friday. So far, it's kind of got knocked back. They're not really breaking out yet, but they're on the cusp. Yields obviously have started to break out, and I think, in my opinion, the reason for that isn't because just headline inflation's high. Like headline inflation's been high for a while, but what we thought would happen was once base effects kind of wore off, inflation would go away. Well, that's over. That was like 4 months ago. Base effects went away, and inflation's still really high. So I think everyone had to take a hard look at that and go, okay, well, from that standpoint, it's not transitory. And then people were like, oh, well, it's just some prices. It's just stuff because of the pandemic. It's just, well, first it was lumber before it crashed. Well, now it's lumber again, I guess. But or just shipping costs or used cars, like whatever you want to point at. It was like, oh, it's just that stuff. Like the rest, everything else is fine. And that held water for a few months, but now that's breaking down. If you look at median inflation, or you look at the Cleveland Fed's 16% trimmed mean that strips away the highest 8% and the lowest 8% of the inflation readings to get rid of the noise on both sides, and that is just ripping higher all of a sudden. So you see these inflation measures that measure kind of the middle, like the like everyday inflation that isn't extreme. the fact that that's starting to really move higher and with no base effects help, that to me, that's really significant. I think that's why you're seeing break evens break out. That's why you're seeing yields back up. That's why you're seeing commodities kind of re-enter a significant bull market. Cyclicals starting to, outpace defensives again.
Yep.
You kind of see all of that starting to work itself at the same time. And if you look at a chart of 10-year real yields, to me it looks like that could rip lower to where you could have real yields more negative, and that's where you can kind of see that breakout in gold and silver kind of find some footing, at least for a while. To your point though on FX, I'm really struggling with FX right now. So personally, I'm long Canadian dollar, Russian rubles, the Norwegian krone against the euro, like basically a lot of energy exporting.
Yep.
is that's where I'm at, FX wise right now. I especially like that, the Norway Europe cross, because one of them is a massive exporter of energy and one is a massive importer of energy. So not to go back into energy too hard, but I just think that that's a nice setup. But as far as the US dollar itself, I just be honest, like I don't have firm feelings. I think we should be in, in the early innings of like a multi-year decline in the dollar. But this energy thing, if you get, or really just a fiscal policy thing, there's a lot of setups where the US outperforms on growth versus Asia and Europe. They call it the rest of the world essentially. And so, I mean, if you have the lights going out and factories shutting down in Europe and Asia, as we already have, and obviously could get worse in the winter, and the US is kind of the last man standing. Like, sure, we may have some outages too, and our nat gas prices will get expensive too, but just way less so and later than the rest of the world. So if that happens, you can easily see a scenario where the dollar can move substantially higher, just based on basic, relative growth, relative yields. If the Fed's starting to freak out a little bit and they're talking about raising rates, first half or something, where in the ECB is just like, man, we're never raising again, like, because we're having negative growth because we had to shut down all of our plants. Like, it's just really easy to see a nasty dollar scenario, and I think that's something that people should really take seriously headed into the winter, especially for people like me. Like, yeah, I'm really long a lot of these commodities that are doing great, but if the dollar gets unruly enough, like that stuff starts to take pain. So that's why for me the dollar that's kind of my natural hedge, because I'm typically long real assets. So instead of buying S&P puts, I'd rather buy dollar futures.
Yeah, that's so. You sort of talked about the framework of U.S. versus the rest of the world. And do you have any thoughts on emerging markets going forward? Number one, some of them are probably going to get hit hard by the coming energy crisis. Considering that they tend to import a lot of energy, but on the other hand, things like Brazil, EWZ, the Brazil ETF, it's been coming down quite a bit, and so obviously not at say March 2020 lows, but you just generally speaking, do you have any thoughts on emerging markets going forward?
Yeah, so I very much right now break them out by energy and food imports, exports, basically where they stand with commodities. And I want to like Brazil a lot more than I do. It's a great setup, but they need some political stabilization, and right now, I mean, they can't raise rates fast enough to really catch up with inflation. So they're just in a weird spot at the moment. I think you can get to a point in a few months where that's a great trade, but you got to wait for it to like actually turn. But I think, I mean, they had weather problems that were a big deal for them because they're such a massive exporter of both energy and agriculture. And when you don't have enough rain, that impacts both. So I think that will kind of start to sort itself out this year. They're going to get a lot more rain. Looks like they're getting a lot, here short term, which will help with hydroelectricity.
Yep.
So you don't have to import as much LNG, things like that, as well as, watering, all those crops. That's going to be a big deal. When I think about it, but there are some, just in my opinion, really big risks in emerging markets. Number one is Turkey. Obviously, they have insane monetary policy. They could easily have food inflation above 50%, in coming months. I just think that one can honestly get out of control. I'm a perma bear on South Africa because I see just incredible political risk and just societal risk in that country. And obviously they import a lot of energy. So I think there are some scary spots that, you know, can work as shorts. Pakistan is another big energy importer. That's a big problem for them at the moment. So yeah, there are some shorts in EM, but yeah, you look at places like Russia, hopefully at some point Brazil, and I think there's going to be some pockets you can jump into in EM that they can do well. Maybe Southeast Asia is a place where, you know, they can get on track as well.
Yep. And going forward, what's sort of the next big trade? Yeah, I guess that's a convoluted way of saying it, but what's sort of on your mind in terms of trades going forward from this
Sure.
point?
So I'm you know, the next big trade is always what I'm thinking about, because you're always eventually going to have to move on from what you're doing, unless you're just a buy and hold person ignoring markets. But obviously I'm not. So for me, two things stick out. Agriculture is I think is gonna take the baton from energy at some point. Specifically, I think corn can have an unbelievable next 18 months, especially largely because of fertilizer disruptions due to natural gas prices. And the other thing is cannabis. I think cannabis is a really interesting setup and a really good setup. And again, this follows my framework of finding things that are unloved and beaten down, because it is right now. It kind of had a nice little bubble that blew up. We're down 50% from there, which is exactly where I like to start digging in on trades. And when you just kind of look at the fundamentals, they're just all good. It's a high growth market. It is something that's gaining acceptability globally every day.
Yep.
It's gaining kind of legal market share, if you will, every day globally. And but there's still a lot of kind of, I would call them synthetic constraints all around cannabis. They have to pay a fortune to borrow money because it's viewed as risky. They can't actually bank, in a normal fashion in much of the world, including in the United States. That all that kind of creates all this regulatory burden that I think will naturally kind of melt away over the years, at least. It just I just picture all that regulatory burden as a bunch of catalysts that are just built in. So if you picture like a timeline moving forward, you can just kind of picture little catalysts that you don't know where they're going to come on the timeline. You just know that they're going to come on the timeline where, all of a sudden they can bank and they can, import export differently. And not to mention the fact that, young people might convince old people like, hey, this is actually okay. It's not, the devil's lettuce or whatever. So you just have a lot of different unique catalysts lining themselves up. It's cheap. A lot of these companies have just fantastic cash flows as it is. And they're paying exorbitant amount to borrow money. So eventually they'll pay, a lot closer to just normal market rates to borrow money. They'll be able to get normal financing. All that stuff will raise already high margins significantly. And I think all this stuff, for call it 3-5 years from now is badly mispriced.
Got it. And what do you see on ags? Is it sort of similar to the sort of a food shortage, just like an energy shortage, or?
Yeah, essentially just supply and demand being, a problem. Much like we got used to abundant supply of energy, we got really used to abundant supply of crops. We didn't have too many weather disruptions. We had the US, Argentina, Brazil, you name it, like just having really great crops year after year after year, and expanding, how many acres they plant every year.
Yep.
Almost, it seems like. That is a lot of that's sort of naturally coming to an end. Input costs for everything farmers do is getting more expensive. So obviously energy costs are getting more expensive. Fertilizer costs are truly going parabolic, and that is a significant portion of farmers' outlays for what they do operationally. Tires, tractors. I mean, John Deere workers are on strike right now, so I don't think tractors are going to get much cheaper.
Yep.
Pesticides are going through the roof. So you can't really name an input cost for a farmer that isn't going up. The actual farm land prices are going much higher. So if you get that combination, like you have to have higher prices for these people to keep planting as much as you need them to plant. or they won't plant as much, and so you get this situation where you get high prices and you win, or you don't, and then you get a season where no one plants as much as they should, and then you get the high prices. So it's almost like you get high prices either way. And the downside risk is they don't pass along any of this costs, which is really difficult to imagine. Especially, you look in the US where we give out significant farm subsidies, but they're falling a lot year over year. So it's not like the government's going to just back them up for all the losses they're going to take. They just won't plant as much, or they'll plant other crops, different stuff. That's why I like corn. I think you're going to have a lot of people planting soybeans instead of corn, because you need less nitrogen fertilizers for soybeans and corn, and nitrogen is just going nuts because it comes from natural gas. But it's not just gonna be corn though. It's gonna be other things. Like I like rice. I like winter wheat, and some of this stuff's for the weather. I think weather's going to be more volatile than it has been recently moving forward, and that is a big problem for production. So it's a combination of a lot of factors for the reasons I like agriculture, but that kind of encapsulates most of it.
It was sort of a great overview of both the MSO trade as well as ags. And how do you determine trading timeframes that based on sort of this macro research? And also, how do you think about timing stuff? So, for example, I know people who've been on uranium since 2017, for example, and it's been cheap for years, and it's just sort of over this year and over 2020 that's actually gotten the love that it's supposed to get. So, how do you think? So, number one, how do you think about trading timeframes, as well as how do you think about timing these trades? Because I know you used a lot of technicals, so it would be interesting to sort of share that framework.
Yeah, I mean, at the end of the day, the execution is all comes down to technicals for me. Well, I shouldn't say all, mostly comes down to technicals for me. There's definitely always a fundamental overlay. That's usually more for after I get in a trade, the fundamental part. But so yeah, I'm looking for breakouts to actually enter. So like right now, I just talked about cannabis, and I told you how great it is. It's going to be a wonderful investment. I own 0 shares of cannabis right now because I'm waiting for the price to tell me it's time to get in.
Yep.
I don't always get that right. Trust me. You mentioned 2017 in uranium. I go back to 2016 with uranium. I've just been slowly adding to uranium for 5 years, and yeah, after 4 years of doing nothing, it finally started working. So I wasted capital really for a while there. I just felt that strongly about the fundamentals, but sometimes, I mean, I'll do a trade that's very tactical that I don't feel like there's a lot of runway. That's why I separate 2 different styles, 2 different portfolios. One's tactical, 6 months or less, and the other's strategic and longer than 6 months, because I want to trade at both speeds. Because some trades, they don't belong in one of those buckets. They only belong in one. And you should always know when you're entering something, which bucket that's likely to be in. So obviously sometimes short-term trades go long and on the opposite, but
Yep.
Understanding what is likely there is important. And a lot of times this just comes down to fundamental runway. So this is why I like capital cycle investing. You look at oil and you can see the runway is still there because the capex hasn't come.
Yep.
So as far as how long I'm going to stay in or where I'm trying to get out, it's going to be based on that. Like whenever the supply response starts coming in and everyone's over their skis and positioning, all that kind of stuff, that's when I know it's time to move on to something else. And yeah, you manage the risk largely with technicals and just make sure you're refreshing your fundamental view, constantly, always red teaming what you think about a market and kind of going back to zero on it. And usually people wait to a big drawdown to go reassess their trade, but yeah, you should just be doing that constantly.
100%. And how do you think about allocating? So you mentioned that you sort of run 2 different portfolios. One is tactical, the other is strategic or positional. And how do you think about allocating within both those frameworks?
Yeah, so I term bucket personally, and then kind of have that more frequent trading in the tactical side as kind of like a 30-40% allocation, and try to use the profits from that to just basically feed into the longer term stuff that I have longer term conviction on. And there are some things I'm just always going to have in my portfolio. Like I'm just always going to have some just basic equity exposure. I'm going to have some gold. I'm going to there are some things that are just always going to be in there. For me, timber, I'm just always going to have some timber because it's just different. It's going to throw off some yield. the land value goes up, the trees grow and become worth more every year. Like I'm just always gonna have timber in my portfolio. So there are some things that are just kind of baked in the cake,
Mm-hmm.
and I'm always just gonna kind of add to. And then there's other things that, I'm really long copper on a strategic basis. There's gonna be a point where we produce too much copper, and I'm gonna pull that completely out of my portfolio. Same with oil. Like oil's gonna reach bubble at some point, and we're gonna try to produce too much, and I'm gonna have zero oil allocation left.
Yep. And sort of to wrap up the podcast, I wanted to ask you, if you had to give, your top 3 tips for investors, what would they be? Or top 3 takeaways from sort of your career of investing, what would they be? And also, what's your favorite ice cream flavor? I remember that was on Twitter, so I had to ask that.
Yeah. So, I mean, it's hard for me to pick between two. So I kind of have 2 favorites, and it depends on the mood: mint chocolate chip and butter pecan. So it just depends on which way I'm feeling that day. But that was one of my favorite questions I saw too. As far as like some takeaways, I think people are always looking for super shortcut, easy tricks, and it's usually like around the way they execute or some like little signal or indicator. It's stuff that everyone's doing. To me, like one very basic way to try to gain an edge is to understand at a fundamental basis cycles, and a lot of different cycles, and then human beings, and the way we kind of extrapolate. It's just in our nature to extrapolate, and almost always you can find. So at any given moment, I think you could jot down 5 things that you think are being extrapolated, and then go research those 5 things and figure out, oh wow, like we're extrapolating, this thing into the future, and that's wrong.
Yep.
And so if you can just basically counter trade against false extrapolations, you can always find good investments in the market, because as human beings, this is a fundamental flaw we have. So don't ignore the playing the player aspect of markets, and realize that there's money to be made just fading extrapolations. And again, you got to wait for the inflections and the technicals to line up, and you got to make sure the fundamentals are real and they can hold all that stuff. But that's something I don't see enough people like, having inside their framework. They're too busy, tearing up a balance sheet or finding a fraud, or just trying to bang their head against the market, just because of their personal feelings or something. Like
Yep.
There's a lot of underlying trends based on the deep fallibility of human beings that you can find in markets.
Awesome. And with that, I think that's a great place to leave off. And before I let you go, could you sort of give the audience, where they can find you and your work?
Yeah, sure. So you can find me on Twitter at Pinecone Macro. We have a website that's pineconemacro.com, and we're about to roll out a brand new website here in the next week or 2, hopefully. And that's going to be a significant upgrade over the website we have right now. So that'll be nice. Look out for that. And people can email me directly at chase@pineconemacro.com if they want to reach out that way.
Awesome. Chase, thank you so much for being on the podcast. It's great having you.
Yeah, pleasure to be back.